Okay, welcome back, everybody, to episode 107. So, I do apologize. It's been a couple of weeks since I've done one of these. As I explained, I think maybe 2 months ago, I'm basically trying to live about 2 weeks in every different district around Dubai. I'm trying to determine what are the best areas for real estate investment, and I want to actually live in them and go out into the community and, shop at the grocery stores and see what the malls are like, do some running, see what's actually the best regions. So sometimes they're a little bit hit and miss. The one I was in last week, couple of weeks there, it was a wide open room. There was no carpet on the ground. So it was actually super echoey. So I basically just skipped a couple of weeks of the live streams. But we're back, and I actually have a really good topic today. So hopefully today I'm going to try to take people along the path of maybe getting out of that buy and hold mindset and pushing more towards that tactical rotation style that I am doing, that my work is based on. So maybe try to kind of get some in between ground there. And the one question that I often get when people are ready to dive down this rabbit hole, they think, okay, well, I know I can't buy and hold. I know the drawdowns are going to be excruciating with that. So could I potentially use the VIX futures, apply that to the S&P 500, for example, as a trading filter, and maybe come out with some better results? So we're going to use that as the backdrop and hopefully go down a few steps further. So let's get into that. Okay, so I've got some basic data here, and we're going to be starting from the baseline of the S&P 500. I understand that for buy and hold investors, there's other things that they could be doing, but just as a baseline, this is by far the most popular index. So we're going to go ahead and start with this. And this is going back to March 26, 2004. The reason that's interesting, that was also when the VIX futures actually launched. So that's the date that we're going to go back to for all of these numbers. Now we can see 9.72% annualized return with a 55.19% maximum drawdown. So I'm sure you've heard it said many times that if you buy and hold the S&P 500, you'll make about 10% return. Now there's several problems with this, and the first one, of course, is that we do have to remove inflation. So even though that number doesn't seem very good in the first place, it's actually even worse because inflation is probably 4 or 5%. Now I understand the Fed, the government, they're going to say it's 2%, 3%, whatever they say. But I think anybody living in the real world knows that real estate, for example, buying or renting, it definitely goes up a lot more than 2%. For food, for energy, for basic living expenses, we all experience inflation far higher than what the government is actually saying. So I think 4 to 5% is about reasonable. Bottom line, the S&P 500 long term is probably going to make about 5% a year. Now the second problem is that that is also highly dependent on the starting point. So if you were to dump all your money in a very good entry, say somewhere around the financial crisis, or sort of near the bottom of COVID or 2022, then yeah, you could probably do a little bit better than that. But with markets near all-time highs right now, it's totally unrealistic to expect that 10 or 20 years going forward, starting today, that it's going to be anywhere close to that 10%. It's just not. It's highly dependent on where you start, and right now, if you were to dump your money in May 2025, come back 20 years, the annual return is not going to be 10%. It's probably going to be closer to 5%, and then you back out the inflation and you're at zero. We could very likely be looking at a lost decade or two. But the third problem with this, and by far the most impactful, almost nobody has the risk tolerance to sustain a 40 or 50% drawdown and stay the course. It's going to feel like the end of the world. They're going to pull the plug. They're going to capitulate, and that's going to break the entire system. So what I'm trying to get at is that buy and hold on its own is a terrible rate of return, but when you factor in the emotional roller coaster that it's going to be, almost nobody's going to even get that. They're going to make mistakes at the wrong time, and it's going to be a much worse rate of return. So buy and hold is a total non-starter. Even if you were in that maybe 1% of investors that could watch their net worth go down in half and still wake up the next day and keep going, you're still only looking at a mid-single digit rate of return. So we need to do better. Now, the thing that often comes up is, could we actually use the VIX futures as a filtering device? Now, just really quickly here, I've got a million videos talking about the VIX futures, so I don't need to go into too much detail. But the VIX futures are a freely traded market. It's just traders buying and selling based on their opinion on the market. Each one of the monthly cycles going out further in time is representing the market's opinion on where volatility should be priced. So for today's purpose, all we really need to talk about is the difference between contango and backwardation. So contango, this is what would be represented by stable markets. When everything's calm and very likely the S&P 500 is just trending higher, the VIX futures will be in contango. That means that the further out months are going to be priced higher than the closer months. And this makes sense, right? From a trader's perspective, when everything is calm, more bad things can happen further out in time than maybe just a month or two. So traders are going to require a volatility risk premium in order to take those trades further out in time. They're going to have to be priced a little bit higher, and that's why you get this upward sloping curve. We call this contango. But when the market is very unstable and traders are worried about something happening in the market, they will actually align themselves in what we call backwardation. That's when the longer dated futures are actually lower than the shorter dated futures. The current market is panicked, so these are going to be very high, but it's rational to assume that the longer you wait, the more volatility will die down, and those ones should be priced lower. So we only see this during extreme market crashes and when the risk is the highest. So that's why, as a filtering mechanism, what if we were just going to be long the stock market when the VIX futures are stable, and we're going to move to cash every time they're flashing warning signs? As a general trading hypothesis, this makes perfect sense. So the VIX futures, this is the M1-M2 ratio, going back to 2004, and it turns out you can see that they are actually in contango about 84% of the time. And 16% of the time, they are showing elevated levels of risk. So just to get the conversation going, what if we were to just do that? What if we were to be long the S&P 500 during contango and in cash during the rest? Now, I've got some other statistics here. I might circle back to these as I'm talking, but you can pause if you're interested. But basically what we're looking at is this. This is that test. This is long the S&P 500 going back to March 26, 2004, holding the SPY every time the VIX futures are greater than 0. Oh, I can see that sign. There's a little bit of a typo there. Anyway, I think you get the point. I'll clean that up a little bit later on. But long SPY when the VIX futures are in contango, and then in cash when it's not. You can see the test here. Basically, the rate of return does actually come down a little bit. So some people might look at that and go, oh, it's worse. But actually, I would submit that this is significantly better already. And the reason for that is what I said before. Almost nobody can sustain a 55% drawdown. Now, 39 is going to be bad as well. But that's the nature of drawdowns. If you can keep your drawdowns in the 30s, you're going to be much better off as an investor. Remember, losses are always more costly to a fund than gains are beneficial. The larger drawdown you suffer, the more you have to make after that just to get back to break even. So just to illustrate this, we always do the standard example. Let's say a trader has $10,000 and they make 50% in 1 year and then they lose 50% in the next year. Are they back to break even? Well, a lot of people would say, yeah, they just, they're back to $10,000. You make 50, you lose 50, it's a wash. But actually think about what's happening. You start with $10,000, you make 50%, now you're at $15,000. But investment results compound over time. So when you're at $15,000, compounded geometrically, if you then lose 50%, you're not back to 10,000. You go down to 7,500. So you're down 25%. Make 50, lose 50 is not break even. Make 10, lose 10 is not break even. That's the result, is that actually it's the losses that are far more punishing to investors. That's what we need to avoid. So looking at this here, if you have a 50% drawdown, you're going to need 100% just to get back to break even. But if you can keep it somewhere in the 30s, or even the 20s would be even better, but somewhere in the 30s, you're kind of still within striking distance of getting back there. And so emotionally, hanging on a 39% drawdown is far, far easier than 55. I know it seems like these numbers might be close, but emotionally, there's a huge gap between 39 and 55. But let's see if we can do a little bit better by going a little bit closer. So now we're using minus 3% backwardation. I think this is why I did the typo, because I'm actually going negative here. But we're basically trying to reduce the number of trading days we're in cash and see if we can even improve on this. So now we're down to 91.59% of trading days in the SPY and only about 8.5% in cash. Kind of the same result. Lower return, slightly lower drawdown. Not a whole lot to talk about there, but let's keep going. Down to minus 6. Now we're down to 95.6% of trading days in the SPY and only moving to cash on 4.5% of trading days. So not bad, but not much of an improvement here. Let's keep going. So now it's the first time we can start to see some benefit for exiting just those worst days. This is now backwardation of minus 9%. You can see this is only happening on about 2.5% of trading days. So this person is going to be buy and hold the SPY most of the time, and they're only exiting to safety on 2.5% of trading days. Just on those days when clearly you would not want to be in the market. You will see extreme backwardation every time. It's one of those things where just because the VIX futures are in backwardation doesn't necessarily mean the market's going to crash, but what it does show is that every single time the market does crash, the VIX futures are in strong backwardation. So as a trading signal, that's what we're getting at. And once we get into that -9 range, you can see the actual rate of return is higher now. It's almost 2% higher. And the drawdown is much lower. Again, 37.55, some people might think that's kind of close. It's nowhere near as close. Emotionally speaking, 37 is way, way more manageable. 55, I mean, good luck with that, especially when you're talking about, could you imagine hanging on a 55% drawdown and your reward for going through that excruciating pain is a mid-single digit rate of return? I mean, we're not talking about Bitcoin here, where if you do hang on, you might make 50, 100, 300%. With the S&P 500 buy and hold, you're literally hanging on, losing half your capital for the potential future reward of 5% per year. It's lunacy. But getting to 37 is actually fairly manageable. So let's see if we could go even a little bit further. Let's go to -12. Now we're talking about just moving to safety on 1.5% of trading days. Buy and hold 98.5% of the time. Again, rate of return higher, drawdown much more manageable, but it's not better than the 9. So it seems like we kind of found a sweet spot somewhere around -10% backwardation. Now this is where you can start to think like a tactical investor. Because that on its own, the -9 on its own, this is already a massive improvement. Rate of return a little bit, but drawdown, massive improvement. But now you can start to think like a tactical investor. What am I going to do with my capital on the other 2.5% of trading days when the market is completely falling off a cliff? Well, what were to happen if you would just allocate to bonds? So this is the TLT, 20-year treasuries. Now look at the results. With just one dirt simple filter, you're going to exit the SPY 2.5% of trading days on the most extreme levels, and you're going to put your capital into bonds. Well, now your rate of return, again, 2% higher, is definitely significant. 2% higher long term is worth it, but the maximum drawdown much more manageable. This investor probably could stay the course. Now, again, I'm not trying to say that anybody should actually do this. I know for me, 5, 7, 8% rate of return is not nearly good enough. I hope it's not good enough for you, but I'm trying to illustrate that there is a bridge here between buy and hold, which is lunacy, and then the eventual goal of being an effective tactical investor. So we can also look at what happens if you put your money in gold instead of treasuries. Probably even a little bit better, to be honest. 12% return here, 35% drawdown, and you have the added benefit that it does seem the way the market in the world is going with the debt issues and all of this tariff nonsense, the rise of crypto. It does actually seem like gold is holding up really well, and there might actually be a case that gold continues to behave as a really good safety asset. So I would say of the things that I've shown so far, this is the best. But now we want to kind of keep going, and that's where we get into what I do, all my videos, all my live streams, my community, the VTS community. Because I don't just use the VIX futures. Obviously, the VIX futures are important, but they are just one small aspect of the market. So I have designed my volatility barometer. This is currently using 13 different volatility metrics from all ranges of the market. It's all combined into a single index, right? This is the value for yesterday, around 60%. But you can see how easy this is. Now, a lot of work goes into this. It's far more complex than it looks. But from the person's perspective on the other side, it is just a simple one number index. And with this, now I can start to isolate my trading. So this is my portfolio. And whenever you see pie charts like this, you're probably used to seeing different allocations of an asset class that in of itself is supposed to be buy and hold. So maybe this is the S&P 500, maybe this is treasuries, maybe this is gold or something, real estate. What I do instead is I have different strategies that on their own, each one has its own built-in level of risk management. So when you trade 4 independent strategies all within the same portfolio, it offers much better diversification and of course the end goal, higher return, lower drawdowns. But just as an example, let's isolate strategic tail risk today. So this is the signal for yesterday, just barely in that Berkshire Hathaway range. You can see here the trade dial. Again, a lot of complexity goes into all of this behind the scenes, but from your perspective on the receiving end of the signal, it couldn't be easier. Wherever the dial points, that's the asset class we're going to be holding. And now we can do what we did before. We can kind of look at the individual results as a tactical investor. So that first range, the Berkshire Hathaway range, you can see here it's happening on about 70% of trading days. So during the stable markets, VIX futures are in contango, roll yield is positive, cash VIX term structure is upward sloping, volatility risk premium, implied over realized, is going to be elevated. All of the things that I'm looking for to be in what we would call our aggressive position. You can see Berkshire puts in about 12% return with a very manageable drawdown, which is better than the S&P 500. Now, truth is, this is fine as well. Keeping the SPY drawdown to 22 is also totally acceptable. And an 8.5% return on just 70% of trading days, that's a good baseline. But actually, as it turns out, Berkshire's actually even a little bit better. But this is only 70% of trading days. So what do we do with the other capital? This is where tactical investing comes in. The second range, we can use IYR, which is a real estate ETF. Now, it says Coke as well, rate sensitive. That essentially just means any time that the Federal Reserve is in a rate rising environment where they're actually increasing interest rates actively, then we would actually be better just going into Coca-Cola. IYR real estate is a little bit rate sensitive. You don't want to be investing in that when rates are rising. Now, that's highly unlikely. We've been using the IYR for years, but it is mentioned there that at some point in the future, I would suspect we might use a little bit of Coca-Cola. But you can see the results here. This is happening on about 25% of trading days. Another 7% return with a very manageable drawdown. Much better than the SPY on its own. And then the third range, we do still have about 5% of our capital, and we're not going to move into cash. We're going to move into the Chaos ETF. So you can see here, Chaos is in red. This is the results for the actual trades. And remember what I said, SPY, every single time there's a market crash, it's going to be happening when VIX futures are highly elevated, when volatility is highly elevated. It doesn't mean it's going to crash, but every time it does crash, you can guarantee that the volatility metrics have given us the sign. That's why there's a 30% drawdown in this range for the SPY. This is where it's all happening. Obviously, this is the range we want to move to full safety, and that's what the Chaos is. It's basically a tail risk ETF. This drawdown, super manageable and a little bit of bonus return there. So then when you add it all up, each individual section might not be world beating, but then as a total system, this is where you get the results. And again, like I said, the number one goal is always drawdown reduction. 33.72, I promise you, if you were to go back to that day right around the second week in March during the COVID crash, it seemed like the end of the world. Buy and hold investors, they were definitely had already pulled the plug or really about ready to do that. That was a terrifying time. If you were a buy and hold investor, you would have thought in the moment that you've made a terrible mistake with your money. That's when that happens. But if you can keep the drawdowns low, then you can go through those periods and still stay the course. Remember, investing takes place over multiple decades. But this is tactical investing. This is the result. And look, it might seem complicated at first. And like I said, on the back end, it certainly is. But this is not complicated. It's only about 2 to 3 trades per month. This is not like we're switching every day. If we get into Berkshire and it's a long, stable market, we could be in that position for 2 or 3 months without exiting. This is not something that we're bouncing around daily or anything. It's very easy to follow. But the point is, tactical investing, when you understand that volatility can give us those signals, and it's never a guarantee. Like I said, just because volatility is in a certain range doesn't mean the market's going to behave in the way we want. It just means that if you harvest data through all of history, every single time the markets are stable, volatility is low. So that's why we would be in stable stuff. And every single time the market is crashing, volatility is elevated. It's all in this red range. So of course, we're going to move into IYR and then the Chaos ETF. So overall, getting back to the very original question, can you use the VIX futures to improve on this? Well, yes, you can. If that's how basic you want to go with this, then I would submit a lower drawdown is already a victory. But the 0% line, that's actually happening quite a bit. That's 84% of the time. You can do better than that if you just go to the -9, right? Somewhere around here. That gives you 2.5% of your capital to allocate to something else. And you can handily beat the S&P 500. Certainly on the drawdown range, it's not even close. And then if you do want to dive down that final rabbit hole and actually learn how to do this for real, that's what my work is all about. So there's tons of videos, there's live streams, there's Q&As you can come. Of course, I don't charge any money for the live stream, so don't super chat or anything like that. We're going to get into the live Q&A now, but because I don't do any advertisements, I've never talked to any sponsors or anything like that. I don't do any collabs. I don't run ads on my live streams. I'm not going to stop and talk about mattresses or stuff like that. But we do have one word from our sponsor, and then we can get into the live Q&A. So we'll get to the live Q&A in just a second here, but I launched VTS all the way back in January 2012 with two main goals. First, to crush the financial industry and help investors start making real progress towards their retirement goals. And secondly, to provide that outperformance at a much lower cost. A low monthly subscription fee scales far better than paying a traditional percentage of assets. Now, our portfolio is currently 4 strategies with low correlation to the stock market and to each other, so it's a completely diversified total portfolio solution. It's also not active day trading, and trust me, anybody from any background can follow VTS in just a few minutes a day. Since retiring from pro golf in 2005, I've been an options and volatility trader for over 20 years now, and I share a lot of invaluable volatility data in every daily email to subscribers. I'm also a certified workaholic, and there's a growing list of courses that all members have full access to. There's a free trial to VTS on my website available to everybody. Come join members from over 70 countries around the world. I can definitely help you achieve your financial goals. Now let's get into the live Q&A. Okay, so hopefully everybody kind of understands that system that I'm going through, using those volatility metrics to filter out sort of the best asset class in the moment. And of course, we do this, I should just show this really quickly. We do this on multiple different strategies. So the one that I showed you, this is today's email, by the way. The one that I showed you is called our strategic tail risk, but we do also have defensive rotation, which functions sort of similar to the other one in respect to it's using a set of volatility metrics to filter out, but then of course it's using different volatility metrics because it wouldn't be diversification if they're both using the same metrics, but then it also uses different asset classes. And if you look closely, the thresholds are also happening at different levels as well. And then we have a pure volatility strategy, or mostly pure, short volatility during the aggressive periods, long volatility during extreme crashing markets, and then gold. And again, different volatility metrics, different thresholds, different asset classes in those thresholds. So all three complement each other. But I'm really big on the tactical investing side of things. As you can, tune into my live streams, you know that by now. But I do think that while it doesn't work all the time, certainly there's plenty of times where the market's just not cooperating, bouncing in and out, and you just happen to be in the wrong position. Like I said, just because volatility is saying that historically speaking, you should be in this asset, doesn't mean that that asset is actually going to perform well. It's just law of large numbers. If you do this for long enough, then yes, it starts to align and everything kind of gets towards those long-term averages. So I'm huge on the tactical investing. Obviously, I don't support buy and hold in any way, shape, or form. And that's why, if you just start with the initial premise, can you hold? Basically, everybody has to answer, if they're honest, they have to answer that question, no. Of course, most investors were not investing back in 2008. Most asset managers, most financial advisors were not investing 16, 17 years ago. A lot of them are new. Probably 80% of the investment world has never been in an extended drawdown. So they'll say, oh yeah, sure, look at the chart. It went from A to Z. Sure, I would have held on. But really, you have that level of risk tolerance? I don't think so. So if you start with the premise that when things get really bad, you're going to screw it up, then you have to do something different, right? You can't just wait for that day to happen. 10 years, every 10 years, you get a major recession, give or take. And then you realize, oh, wow, I just gave up 10 years of my investing time horizon because I thought I had risk tolerance that I didn't have. So if you start answering that question honestly with no, I cannot sustain a 55% drawdown, then what's left? Well, we have to look at other things. And this is my style, at least for the trend following. Obviously, I do a lot of option trading as well. But yeah, I'm really big on that stuff. So hopefully people understand the process there and dive in. Tons of videos. Tune into the lives, ask your questions. I'm an open book. You can ask me anything. We'll try to keep this, I say this every time. We'll try to keep this to about an hour. Let's see how many questions are here. Doesn't look like that many, so there'll probably be more showing up as I start yapping here. But yeah, ask me anything, of course, off topic as well, if people just like to hang out and chat about different things. Like I said, I'm in Dubai, bouncing around to a million different Airbnbs, trying to nail down which districts I could actually see myself buying real estate in. So, that's what we're up to. So let's get into these questions. All right, so the first one, yes, let's go. Sorry about the wait. Consistency. It's just not my thing. I say this all the time, but I really should get a live stream a week. There just seems to be interference every now and then. And to be honest, the bouncing around different Airbnbs is not helpful. The wife is tuning in. I've been working like an absolute dog the last 2 months. Probably, usually I'm in the 10, 12 hour range, like 14, 15 hour days. And for the purpose, in a couple of weeks, it's our 15th anniversary. So happy anniversary to my beautiful wife. But I'm taking her to France for 2 weeks. And she is a wine sommelier. So we're going to be going to the Champagne region for, I think, 8, 9 days. Going to be crazy, doing all the wineries, doing all the tastings. I'm a lightweight when I drink. So I'm going to be basically drunk off 3 glasses of champagne for 2 weeks straight. And then 5, 6 days in Paris. Going to be a good time, but I have been working my absolute butt off in the last couple of months trying to make sure that I can actually take a 2-week vacation. It doesn't happen often, but has to happen. So there we go. Talk about your drawdown in 2000. I assume that means 2022. Yeah, I kind of beat that one, beat that dead horse back then in 2022, and even the first 6 months of 2023. We talked about this on a dozen live streams, but if you want a just general summary, I don't want to go through the whole thing, but essentially what happened, just as a backstory, if you're not aware, 2022 was a losing year for me, my first one in 16, 17 years. I think we were down about 20% portfolio wide, so it was not a fun year at all. But one of the reasons why that happened, a lot of people would say, well, I thought your systems were designed so that you would be moving to safety, and a year like 2022 wouldn't really affect you that much. Well, there was a couple problems. There was several problems. Let me just see top of my head as I'm just yapping here. But the first problem, of course, is 2022, the volatility metrics didn't actually spike very much. It was, all things considered, because the stock market was down a good, 26%, I believe, at the bottom. But volatility was actually fairly well behaved during that year, during that time, all things considered. It was a very bizarre market crash where you would think, and 9 times out of 10, if we go back to every other market crash, our volatility barometer would have been flashing really high levels. But it actually spent a pretty decent amount of time in the mid to high levels, which means that we were sort of between thresholds sort of for half the year. Whereas if you would say 2011, 2014, 2015, 2018 had 2 crashes, fall apocalypse and Q4, there was a lot of periods where volatility spiked really high. But 2022, it kind of spent, you can kind of see it here, kind of mid to high volatility the whole year. And so that was a problem, that we never really got definitive, like, let's get out and go long vol type signals. So that was one problem. But the other problem is that this whole system, and I want to be clear, I'm always trying to be fair with the way that I speak, because certainly when you see a presentation like that, you'd think, well, this is just magic. It's just going to work every time. And the truth is it's not, right? There are times when it's just, you get into the position and that position just doesn't work. And 2022 was a year where we didn't have any trouble getting into the safety positions. I got the signals. Like I said, volatility, it would have been nice if it was more definitive, but we got into the positions more or less at an acceptable rate. The problem was those safety positions were also substantially negative that year. So bonds, for example, was in like a 45, 50% drawdown, right? Way worse than the stock market. IYR real estate, utilities, even gold had periods where it was terrible. So all of the safety positions that I'm moving into for air quote safety it is kind of required that those also do pretty well, that they actually behave like safety positions. If XLU is down just as much as the NASDAQ, well, that's not very helpful. And this strategy has changed recently, but back in 2022, this position was the SPY and this position was IYR. But if IYR is down just as much as the SPY, well, then what good is moving to safety, right? It doesn't really do anything. So essentially, I would say that that's, if you're asking, what happened in 2022, it was a combination of an extremely muted volatility response to a fairly serious market crash, and then also the safety positions that we were exiting to also performed terribly. So there's really nowhere to hide in that respect. I actually did an interesting live stream. If you want to know, let me see if I can isolate it. Fair warning, every single time I do this live, for some reason, my labeling system isn't great, but let me try this search function. So worst year ever. Come on, be right. Okay, good. We can use this one. So if you watch this video, I actually, let me pause that. Here, I nailed that absolutely perfectly. So that makes up for the previous misfires. You can see that on a basis of including safety positions, right? Obviously, 2008 was a worse year for the stock market, right? So let's kind of nail that. It wasn't the worst year. This is the S&P 500. It was the third worst year in the last 30 years, right? But that's stocks only. When you include the safety positions, and this is a 60-40 stocks bonds, it's by far the worst year, way worse than 2008. And then if you also include gold, stocks, bonds, and gold, a 50-30-20, again, just miles the worst year ever. So you could certainly make a case that 2022 was a far more difficult investing year than 2008. In 2008, the only real problem was stocks. If you knew how to exit out of stocks, you're good. I mean, you're golden. And if you understand volatility metrics, the VIX went from, the mid-teens all the way up to 80, but it did it in a fairly orderly fashion. So if you were savvy in volatility trading, 2008 would have been a breeze, right? I mean, my strategies weren't fully formed back then, but what I was trading back then did completely fine. 2022 was a totally different animal where not only stocks got crushed, not only volatility didn't flash the warning signs, but all of the safety positions did as bad or worse than stocks did. So what are you going to do in a year like that? Well, I lost 20%. So that's hopefully that somewhere in there answered your question. But I will say that I talked about this an awful lot. Many hours we went through this back sort of around this time. So if you want to go back to the live streams about November 2022 to maybe June 2023, everything I just said will be sort of expanded further with charts and all that. But not fun at all. Like I said, tactical investing, like I've illustrated, it's not magic. It's just in my opinion, a far superior way to invest, but it is not bulletproof. You actually do need the market to cooperate a little bit. I don't know what this means. It's just a standalone. Oh, same person. So talk about your drawdown in 2022. Okay. 40%. So I assume you are saying that the drawdown was 40%. So if memory serves, I think the maximum drawdown was 25.9 or 26.2. So the 40 is not accurate. Now, it is accurate to say that the defensive rotation strategy was down 40%. It was. This one was down 40%. I think this one at the low was maybe down 32%, something like that. Strategic tail risk probably in the 20s. But overall, tactical investing was down in the 30s, maximum drawdown. So that's for sure. It didn't get to 40, but one of the strategies did. This one did. But that's using 2 times NASDAQ. So, understood a little bit. But the reason that it wasn't nearly as bad as I think maybe you're saying there. Remember, we do have option strategies as well. The volatility trend strategy, I think, was up 12% that year. Iron condors were up 25% that year. And so there is some offsetting positive gains from all the option strategies that offset the terrible performance of our tactical rotation strategies. So I believe the numbers, and you can get it on the website, but 20% for the year and 26, we'll call it, as a maximum drawdown, somewhere around there. Not fun at all. 2023 was a good year, so we recovered it fairly quickly. But yeah, 2022 was, at least for me, for my style of investing, that's the year that I will remember forever. It's not the Volpocalypse. That was easy. It's not Q4 2018. I made a profit in Q4 2018. It's not 2015. I was up money then. It wasn't 2011 European debt crisis. I was up money then. For me, my nightmare scenario as a tactical investor is exactly what 2022 was. Terrible volatility metrics combined with safety positions that wildly underperform. I mean, you want to talk about a nightmare, that was it. So let's just hope, that never repeats itself. That would be fantastic if that was sort of a once every 20 years type of thing. But go back and watch that video. You'll find it interesting. Because whenever people say, oh, what's the worst year ever? Everybody says 2008. Yeah, okay, maybe if you were 100% allocated to just stocks and you didn't know how to exit, sure, that might have been a difficult year. But for anybody who knew what they were doing, 2008 was not difficult. 2022 was way, way more challenging, I promise you. All right, let's catch up. All right. I'm scoffing at myself, not you. I promise you I'm working as fast as I possibly can to get the options courses done so that we can relaunch the VTS options community. There's not a whole lot more I can say other than, given the fact that I already have, in the context of other people's workload, more than a full-time job just managing VTS, to add another full-time job to the already existing full-time job, it's difficult. So I only have a couple hours a day to do my videos and my editing, and it's very slow going. I apologize. I wish that it could be done faster. If I just ditched VTS for like 4 or 5 months, it could be done. But as far as, keeping everybody informed of what's going on, as far as YouTube following, as far as the algorithms go, you can't do that. It would just absolutely destroy any momentum that I had. So I'm kind of stuck in this position where I have to keep the VTS stuff going and up to date and active and everybody happy. And then I have to also find a bunch of extra time to do the other stuff. So I'm making progress. That's all I can say. It's slow. Does it bother you when people refer to it as the VIX index when in fact it's the volatility index? No, it never even occurred to me. It's called the VIX index, so it doesn't bother me when people call it what it is. What bothers me is when people call it the fear index, because while it is technically true that about 70% of the time when the market is going down, the VIX is going up, got to remember that volatility is just variance from a mean. It doesn't say up or down. So to call the VIX the fear index, there are times when the VIX goes higher when stocks are going higher. That's happening 30% of the time. And in fact, I don't have the right spreadsheet open, but from 1997 to 1999, 3 straight years, of course, excellent performance from stocks, the VIX index was averaging mid-20s. So volatility is directionless. It doesn't actually mean that it has to be an inverse correlation. So it never even occurred to me that they're naming it this. The VIX index is just a statistic calculated based on S&P 500 options activity. It's called the VIX, so you should call it the VIX. But to call it the fear index, or for people to assume that it's always an inverse of stocks, this is not accurate, and that would bother me a little bit. Not much, because it gets all the big days right. And every time, you get COVID, Volpocalypse, the VIX is going up. But you got to remember that sometimes the VIX will, if you're expecting the VIX to be very low when stocks are doing well, that might be disappointing, because there are plenty of times when the VIX is actually stable in the 18 to 20 range. It could go to the 25 range while stocks are doing well. That can be frustrating if you're expecting that just because stocks are doing well, the VIX has to be at 12. No, it does not. Volatility is variance from a mean. It's not inverse correlation to equities. So, but no, it's called the VIX. Let's call it the VIX, right? It has first mover principle. Let's give them the name. Do you trade equity index futures outside of this strategy? So I don't do any futures trading within VTS or VTS options. It's not that futures are not fine. We do only options. I mean, of course, there's a lot of overlap between options and futures, but it's just one additional layer of education that I don't think I really want to go through. So no, we don't trade any futures, but I do trade a ton of option strategies outside of what you just saw. That is one of our 4 strategies within the portfolio of tactical strategies. But I also have, let's say, 6 high priority option strategies that I'm regularly doing, and then another 5 or 6 that are sort of situational that, you're not trading them every single week or every single month, but when you get the opportunity, you can do that. So yeah, I do a comprehensive, pretty complicated overall portfolio. Do you consider Dubai to be a soulless place without a rich culture and history? So, to be perfectly honest, I'm not the great person to ask questions like this because I am a workaholic. I am on my computer minimum 12 hours a day. And so I don't have a life. I'm not the type of person that would notice things like that. I think Dubai's fantastic. I love Dubai. I love Taiwan as well. Taiwan is basically my home. I'm a tax resident. Officially, I live in Dubai, but my wife and I live in Taiwan. I'm here probably 6 months a year, and I love it. I think it's fantastic. I see very, very little, if any, downside to Dubai. Whether it's a soulless place or not, I think you'd have to ask somebody who's more out there and doing stuff and experiencing the culture and going out to maybe not clubs and parties, but going out and experiencing things. I rarely do that. This is my day, and it's 9 days out of 10. If my wife is not with me, it's 10 out of 10 days. This is what I do. I wake up in the morning. I wake up at about 9. I don't eat till about 3. So I do the intermittent fasting. I eat my first meal at 3. I'll eat, and I'm working the whole time. And then here in Dubai, I have to send my email at about 7 o'clock. So I'm working all day until I get my email sent. I'm on my computer from 9 a.m. until 7 at night, send the email. That's when I get my first break. So I put the computer down for a couple hours and I go either to the gym or I go out running. So that takes about 2 hours when you include the shower and all that stuff afterwards. I cook dinner. I get back on the computer, couple hours, maybe till about 11, 11:30, something like that. And then basically, the rest of the night is still on my computer, but it's sort of low task stuff. So I'll listen to podcasts while I'm updating my spreadsheets, probably till about 1 in the morning. And then I will basically go to bed and rinse, repeat. That's my day. So I'm not actually the type of person who would notice this too much. I'm a member at the golf clubs. I'm a member at 3 different clubs here. We barely use it. But you're not the first person to use that word, soulless, when they're describing Dubai. So perhaps the longer I'm here, and if I sort of find a way to get myself a life, some resemblance of a normal functional life, then maybe I would notice it. But for me, it's just the greatest place because, obviously it's tax-free. That's great. It's not tax-free anymore. 2027, they are charging 9%. 9's better than Western countries at, 40. But it's, there's no crime. It's perfectly clean. It's functional. Everything's convenient. The weather's great for 8-9 months a year. I have no complaints. I love it. But yeah, I will say that specifically that word soulless, I have heard Dubai described that way. By news generating by Mr. President, not sure that rotating strategies are not the best to do for this period of time. This is something that, this is a more philosophical, grand investing statement that you're making here, because there's a lot of ways to say that, yeah, you're not wrong. If I were to say a bad environment for my type of strategies would be a choppy market where One day, it's the most bullish thing in the world. It's the greatest economy the world's ever seen. And the next day, it's Armageddon. And then 2 days later, it's great again. It's all fixed. Don't worry about, that was last Tuesday. Don't worry about that. We're all good. We're golden. All these trade deals are coming in. If you were to ask me what's a bad environment for tactical investing, I would say that. But at the same time, if you make the decision to not trade your strategies that have worked for 15 years simply because it appears like the president is, jerking everybody around, what happens if we see a really long period of great performance? It is totally on the table. Like, you could, not only could you see it happening, but it actually did happen during Trump's previous term. He was volatile then as well. You just never know what environment you're going to be in before it happens. So my system, my thought process is diversification. Follow your system. Understand there are limitations to everything. The best way that I could explain this, and this is super broad and general, but this style of tactical investing, it's not that difficult to see that the best environments for this style of investing would be long-term trends where everything is stable and calm. We're going to crush it in that environment because SVXY is at about 1.6 beta to the S&P 500. So it's technically leveraged stocks. And the 2 times NASDAQ QLD is 2 times the NASDAQ. And then Berkshire is basically about a 0.9 beta to the SPY. So we have a leveraged portfolio under good market periods. And that's why we can go on runs where we substantially outperform the market. And then if you talk about if the market is just falling off a cliff, and let's say there's an extended recession that lasts 6 months or a year, well, we're going to be in a combination of gold, long vol, utilities, cash, and real estate and chaos. So under that environment, while the numbers will probably be positive, and if it's a bad market crash, substantially positive, but the relative outperformance of stocks will be insane. That's actually a good period as well. But that whole middle ground of mid-level volatility, that's going to be a problem. So if you imagine those 3 great periods, choppy markets, recession, those general statements, buy and hold the stock market only does well in one of those, right? Stable markets. Perma-bears that you see always talking about the sky is falling, they only do well during the recession, and then they bleed capital during the rest. What my strategies do, you can never win in every environment. So mine, you could sort of imagine they're like barbell strategies where stable markets are fine, they're great, and collapsing markets are fine, they're great, at least from a relative perspective. It's that choppy middle ground that, the Trump market that we're experiencing now, which is why my option strategies is heavily focused on that mid-level chop. I do almost no long calls or anything like that, like any super bullish positions. The last thing in the world somebody needs to add to their portfolio is more net long equities exposure. A dime a dozen. Everybody in the world knows how to make money when the stock market's going up. We don't need that. My option strategies are benefiting from these types of choppy markets. So tactical investing gets the barbell on either side of good and really bad, and option trading fills in the gap in the middle. So my overall portfolio will do well-ish in every market environment. But individual strategies will never be able to respond to everything the market throws at it. So getting back to your point, do you make that prediction that, I think in the next 2 years, Trump's going to do this for 2 straight years and the market's going to go nowhere. It's not going to crash and it's not going to go up. It's going to chop for 2 years. Well, if I had a crystal ball and I knew that was going to happen, then I would probably heavily weight my option strategies and I would minimize my tactical strategies. But I don't know that's going to happen. For all I know, next Monday is going to be the beginning of a calm, upward sloping market. Exhaustion, let's just say traders are done with this shit. They're just, whatever Trump says, I don't care. Boy who cried wolf. I'm not even going to listen to this guy. Overall, the tech industry is doing pretty well. AI is a game-changing industry. The United States is positioned well for that. I could totally see the US stock market going up 20, 30% in the next 12 to 18 months. I could absolutely see that. So while I can agree with you, it's been ridiculously frustrating to watch Trump fumble around without any plan whatsoever and just jerk the market around left and right. I can't say how long this is going to last, so I can't change what I'm doing. What I've been doing has worked 80% of the time for the last 15 years. And the other percentages, you just do the best you can. You just ride the down periods at knowing that I've got great systems and great results, and I know what I'm doing. It doesn't mean it always works. I'm trying to be, throughout all of my live streams, I try to be honest. Like, it's not magic. We're going to have bad periods. We're going to have periods where you look at it and like, this is not working. I'm done with this. Next time this guy says move to the QLD, out of the utilities and into the QLD, I'm just going to stay. I'm not doing this anymore. Yeah. You might have that knee-jerk reaction. I have to stay disciplined because I know what will work over 20 years. I don't know what will work over the next 6 months. So, long way of saying, fantastic question. There's 5 different layers in this question. I like it. Okay, since you missed the big VIX spike in April by just a few tenths on your long signal, did you decide to recalibrate the formula a tiny bit? No, this is another one of those things that once you start tactical investing, you understand that it just happens. So what he's referring to, this strategy, it missed the big long vol signal, that first day with the just devastating markets. It missed that signal by 1 day. We were less than 1% on our volatility barometer from moving into long volatility and just catching it perfectly. Well, that's not what I'm trying to do. Like 0.5% on the barometer. So the question becomes, do you adjust what you're doing? Well, no, because that would be curve fitting. That would be overfitting your signals to what has happened in the past. It's not going to happen that way again. The next time Trump opens his mouth and there's a devastating market crash, the volatility barometer won't be at 97.23 or whatever it was that day. It might be at 94.4. It might be at 60. It might be at 80. So no, you can't do that. We missed it and we missed it. It would have been great to make that. I think the VXZ was up 8% that day. Would have been nice to get a single day 8% gain. But I've had those in the past. I've nailed it perfectly in the past. And I've had times when I exited the day before a devastating crash. I've done that before as well. But as a long-term investor, you have to look at everything as a law of large numbers equation. You can never curve fit everything and just nail it perfectly. And when you miss something, the last thing in the world you want to do is just go changing everything because it's never going to repeat exactly the same way. So what are you changing, right? You might change it, and then next time, because you made that change, you missed the next one by 0.5%. It is what it is. It's just one of those things that, ouch. But, foregone losses is not the same thing as losing. So yeah, it would have been nice, but okay. We moved into long vol and the next day, and it wasn't a total disaster. It did fine. So yeah. Where am I? A couple new questions coming in. The chat scrolled. Let me keep an eye on the time. Let's try to, I don't know if I can bail in 8 minutes, but I'll try. I talk too much. I blab on and on. This is what happens when you have no life. You have nobody to talk to. Finally, I have somebody to talk to, and I just, just keep going and going. I need more friends. By news, since you missed the big, okay, here we go. This is a new one. All right, Bradley says, Berkshire is weighted towards energy, insurance, and cash currently. How does that figure in your selection in the VTS portfolio? So essentially, it doesn't. I mean, that might sound odd, but it doesn't. Because all I'm looking for is something that behaves better than the SPY. Because like I said, this is sort of the same slide from the presentation before, but there's nothing wrong with the SPY during stable markets, right? This is one of those things that I just say over and over. There's nothing wrong with the stock market when it's doing well. And in fact, it's very hard to beat the stock market when it's doing well. This is one of those things that people lay this criticism on asset managers around the world. Like, you didn't beat the SPY in that year. such and such year, or, you underperformed the SPY in 2022 or whatever it is. That might not be the goal, because if stocks are doing well, it's actually really hard to beat stocks. So all I'm looking for is as a baseline. And look, since we launched this strategy, it's been going for many years. And for almost all of it, we used the SPY. This is a very recent change. If people want to know sort of an expanded explanation for this, if you go to my blog on my website, you go to the articles, because I do tons of video stuff. A lot of people don't know that I write a lot as well, but you can see just this page just started like April 15th. I've already got quite a few articles here. People don't really read my articles. They tend to just watch my videos, but I still write anyway. Here's one here recently on April 30th. I explained why I'm actually using the Berkshire. And I did. I went into the holdings, and I went into the fact that he's holding an enormous amount of cash. And there are reasons why I believe that Berkshire will do at least as well as the SPY. But I only need it to do as well as the SPY, because the strength of that strategy and all of the tactical strategies is every few years when you really need it, the tactical rotation is there. My style of investing is arguably the worst style of investing I could imagine for trying to sell a service, because it takes so long to see it working, right? If you wanted to make money selling a service to the general public, you would want to do higher risk options. You'd want to do crypto trading. You'd want to do something like that. What I do, it sometimes can take a few years to see it actually working, because you require both a bull market and a bear market cycle to see it play out. So there are plenty of times when you're underperforming the market because you're in safety 20, 30% of the time, and the market isn't. The market is the market. It's 100% in the market. So you have to see it play out over time. And so all I need from that Berkshire position is something that performs stock market like, and that's good enough, because the IYR, the chaos, that's all there for great reasons, and it will work stretching it out over time. So Berkshire is just as good as stocks for sure. And when I plug it into my systems, because I do 100% systematic, I can put any ETF I want. That's the benefit. This isn't something that I couldn't test. A lot of people, because they don't have a system, they can't test anything. They can just say, well, yeah, I feel like I would have gone into such and such position. I can say on that day, on February 12, 2016, I was in this position. I was in the SPY. So what would have happened if I was in Berkshire? What would have happened if I was in bonds? I can just plug it in, drag the numbers, and I can see the test. And I can look at it and I can say clearly, I can say with confidence that Berkshire is just as good, if not better, than the stock market, regardless of what he's holding, regardless of where he's waiting. Let's just trust that the trading god, Warren Buffett, knows what he's doing more or less. And yeah, it's going to deliver stock market-like performance for me. Is it going to be as good as short vol? No. I mean, Berkshire, for the last 20, 30 years, has barely outpaced the market. But all I need is the market. So I like Berkshire, and I do like the fact that he does have a lot of cash. It aligns with what my thinking is as well. And I think that he will, because he's going to pass things down, but the system that they follow should do pretty well having such a massive war chest of cash. So I think they're positioned quite well. All right. I had a very similar experience in 2022 where my bonds drew down heavily. Yeah, bonds were down, like TLT was down over 50%. Stock market was only down 26. So yeah, 2022 was a nightmare for diversified investors. In fact, the people that did the best in 2022 were probably the worst investors. Were probably the ones that had no idea what they were doing. So they basically do just buy and hold the stock market and do this. You might have actually been better off just not knowing what you were doing. Because if you were trying to, I'm going to move into safety, and clearly we know over a 20-year period, utilities is way better than stocks, so I move it into utilities. And we know for sure that in mid to high volatility, real estate is better and gold is better and bonds is typically better. surprise, not every year. So yeah, I feel your pain. The only positions I made money in were SPX delta neutral, slightly short broken wing butterflies. Yeah, our broken wing butterfly strategy, it's called the volatility trend. Like I pointed out, the reason the overall portfolio didn't crash the 35 or so percent that the tactical strategies did is because we were trading broken wing butterflies on UVXY and VXX and iron condors and things like that. So there's an offsetting with the delta neutral. And that's why, like I explained, my option strategies are targeting that style of environment because that's what we need. That's what our portfolios need. There are dime a dozen option traders out there that can help you make money if the stock market just keeps going up. You just listen to these people selling put options on just pick your best stock that you'd be comfortable with holding it at this certain low price. Yeah, awesome. In a bull market, you're going to do great. But then what's going to happen when you actually need it? Nobody needs more net long equities exposure. Everyone in the world has plenty of that. What I focus my option trading on is giving people exactly what they don't have in their portfolio, which is something that can make a profit when the market's not cooperating. That's value added. Giving you leveraged net long equities, volatility, option strategies, who cares? I wouldn't pay 2 cents for that. But people do. People join these communities and they're like, oh, we're going to buy call options on NVIDIA and we're going to make tons of money. Okay. You could just own NVIDIA and just cut out the middleman, but whatever. People do what they do. All right. You mentioned living 6 months in Dubai and the other 6 months travel or Taiwan. Do you ever visit or spend months in Canada anymore? What are your views on rent, Airbnb, and freedom that brings versus buying? There's a million questions. I could talk about this all day, but I've hit my limit. It's an hour and 1 minute. So I should try to live 6 months in Dubai because I'm a tax resident here. And I do love Taiwan, and I've been there for on and off for probably 17 years now. And I do love it there. And then the wife and I travel for probably a good month at least, maybe more than that, maybe 6 weeks for sure on the road. And we did, I don't even know how many countries. We travel a lot. Like I said, we're going to France and we're going to do trips later in the year. We travel a lot. Canada. Yeah, I've got a video. I don't want to get into it too much. I think it's actually on the Clips channel. But I got caught in Canada during COVID. And at the time in Canada, I haven't been a resident of Canada since, 2001, I believe. So it was actually a big problem that they closed the borders for me specifically because I was stuck in Canada. I just happened to be visiting my mom. It was in February. They, went through March, April, and then everything shut down. The only way you could get out of the country is if you took the vaccinations. So I was in a situation where at the time I was a tax resident of Panama. I was a member of their Friendly Nations visa program. Panama is also a tax-free country. And so I have to get back to Panama. And I only have a short window. You can't be out of the country for longer than, for me, there was a cutoff period, but Canada closed their borders. So I was in that situation where I can't really fight it. I had to, go to Bill Gates's house and then get out of the country. And so I did that, and I haven't been back since. So I have not been back to Canada literally since February 2020. It just left a terrible taste in my mouth how they handled things. And it wasn't Canada, of course, as an isolated country. It was like 100 countries around the world were doing the same nonsense. So they got me, and no, I have not been back since. My mom lives there still. So I've been bringing my mom out of Canada to do these big trips with her. Switzerland for 6 weeks. We went to Norway and Amsterdam, and we did all these cool stuff. And this year we'll probably do something as well, planning like a cruise to the Mediterranean and maybe spend some time in Morocco. She's always wanted to go there. We would have gone to Italy this year, but apparently there's some centennial 100-year Catholic celebration or something, kind of year round. So the tourism is just off the charts this year. We didn't want to deal with that. But yeah, Canada's, I won't say it's totally dead to me, but that was awful. And aside from visiting family, I could stay out of the country. And then as far as the last thing, what's your thoughts on renting versus buying? I do have a video there as well. This is actually a video I would recommend everybody watch because in sort of my style, my rent versus own, sort of my quantitative style, I actually went through all the numbers and I calculated a person buying a home and renting and investing the difference. And the difference is basically the same. So it's situational based on interest rates, based on current valuations, based on what rate of return you can get on the foregone capital that you would save on a down payment and you'd save in the monthly rent and don't have to do maintenance on the house. If you're a really good investor, you make over 7% a year, then you're probably always better just renting your house that you live in and just investing your money. And whether that investing means buying houses and renting them out, nothing wrong with that. You can make 7-8% a year doing that if you're really sort of that cutoff where for buy and hold blind, don't really know how to invest type people, I typically just say, go ahead and buy your home. You're not going to totally regret it. It's not going to make you any money. All of the gain for these people's houses, it's all inflation. I mean, they don't know that because the numbers go up so much. They say, well, I bought this house in 1994 for 125 grand and now it's priced at 1.3 million or whatever they're going to say. It's just all inflation. Real estate has gone up by about 4.5% in the last 80 years in the United States annually, about 4.5%. Inflation's 4%. So you're really not making anything. And you haven't even backed out realtor fees and legal fees and maintenance and property taxes and insurance and all the stuff that home ownership comes with. I say if you're a good investor, rent your house. If you're not a good investor, buy your house and build the equity. That's generally speaking, you can't go too far wrong with just that rule. If you could make more than 7 or 8% a year with your investments, your money can be better spent elsewhere. I look at it as a pure math formula. If you look at the mortgage rate, if you can make significantly more than that investing, lease everything super long-term and invest as much as you can. If you're not a good investor, it might be beneficial to get into a heavy mortgage. It's a forced savings account. There's nothing wrong with that. It gives people security. There's nothing wrong with that. But having said that, I do own houses. So the wife, like my wife is a real estate person. She has to have a house. So I don't. I could rent. I'm totally fine living Airbnb life. I think it's great. But no, for her, she needs houses. Okay, forward thinking. I feel like I missed something here. Dubai is honestly next level. Everything is so accessible and efficient. I agree 100%. Dubai is a different world when it comes to just convenience of living. You don't know until you're here, and then you're like countries function this well? I didn't even know this existed. I'm from the West, so I didn't know that this existed until, actually, to be honest, Taiwan's kind of like that too. So, but in the last 20 years, I opened my eyes completely. Canada is not it. I can tell you that. I got my golden visa just 3 days after submitting my documents and had my Emirates ID a week later. For me too, people have no idea how arduous the bureaucracy is in Western countries until you go somewhere that actually works. In Dubai, and I had the exact same experience, you kind of dread doing things like that. You're like, God, I have to go get a visa. Okay, this is going to take forever. I have to go to this building and that building. I just had a guy, he just told me where to go and the sign. I would say all in work, including the taxis to get to the buildings that I had to go. I think there was only 2 signatures and I got my visa and I got my Emirates ID. It was literally one here and then come back 2 weeks later, sign the paper again, and you're good to go. It was like an hour probably, including the taxi trip. You show up at the building, there's no wait. You wait 3 minutes and your number's called. All of the desks are in this giant circle around the middle table, and it just functions perfectly. It functions exactly how you would want it to. And then you go get a health checkup and you show up and there's a 5-minute wait and you go in and you get your health check, you sign the paper and you leave and it's done. You want to open a bank account. I went into the Emirates NBD bank. I said, here's what I want. They literally just shuffled a bunch of papers around and gave me to sign things. Boom, I've got a bank account. It's crazy. Dubai's next level. Dubai is what happens when the government wants their citizens to have a good experience, right? That's what it's about. And look, to be perfectly honest, I think it's mandatory. So I'm giving Dubai a lot of credit for just being the most functionally almost perfect place that I've ever been in. But you have to also understand that that's mandatory, because if that stops happening, this place basically just disappears into the desert. This was all made up. This was all, you look at pictures, like where I am now, the Dubai Marina's not there. Like, they made this place in 20 years. They went from desert with no water to what appears to be like a 7-kilometer marina dug out with 150-story buildings surrounding it. Like, it's all just, they made it. And it's all based on tourism, because Dubai doesn't have any oil. A lot of people think, oh, Dubai, they're just spending oil money. Abu Dhabi has the oil, but Dubai doesn't have the oil. So Dubai's tourism, Dubai's services, Dubai's, banking and stuff like that. And it's necessary. So the country is absolutely safe. You could drop your Rolex watch at the Starbucks table and go shopping for 2 hours. You will come back and nobody is sitting in that table. Your watch is still there. It's crazy. But it has to be that way because they have to attract rich people. So once the rich people stop coming, once they start having bad experiences, of course they talk with their friends and they have these bougie parties with each other and they share stories. If you start hearing stories about how Dubai has cracks in the system and people are not happy and the bureaucracy's piling up and it's impossible to get banking done and it's not safe anymore. My buddy got mugged and they stole his Patek Philippe. And you start hearing stories like that, Dubai disappears into the desert. It's gone. So it's one of those things where it's amazing, but it's amazing sort of forced amazing. And that's why maybe it's so great, is because in 25 years, they basically built the perfect place to save a otherwise just random desert, right? There wasn't much here before. And without the tourism push and without thousands of multimillionaires moving here every year, without that, it's all for naught. This whole Dubai experiment disappears. So everything has to function perfectly, and it does. Everything has to be clean, and it is. Everything has to be organized, and it is. Bureaucracy has to be almost zero, and it is. Healthcare has to be brilliant, and it's top-notch. Everything is great here. So is that soulless? I don't know, but it's awesome. I know that. So I don't know of any other countries that do that. Like whatever country you're from, if you're from the UK, if you're from France, Germany, Canada, Australia, wherever you're from, does your government cater to you, or do they just do whatever they want and you just have to suck it up and deal with it? There's a totally different attitude here. They can't afford to tell people this is the way it is, just deal with it. Because guess what? I can just leave. Like David Beckham can just sell his house and leave. Like we don't have to be here. None of the people that make Dubai have to be here. So in a sense, it is what it is. It's a function of necessity. And I think that's amazing. And that's why in 25 years they've built, this utopia in the middle of the desert. It's phenomenal. And people hate on it, but live here for 2 years. What's the worst that could happen? Oh, you didn't pay any taxes. Too bad for you, right? You wasted 2 years not paying any taxes. What's the worst thing that could happen? You'll have some cool experiences. I would recommend it to anybody who has the means to do that. Now, obviously, you would need an online job or your own business or something like that. But anybody who has the means to go and try something new, try something new. When I left Canada back in, 2001-ish, granted, it was for golf. I was a pro golfer, so I had to leave. But I never looked back. Just because you're born somewhere doesn't mean you owe that place loyalty. If they're doing a great job, stay. Of course, stay. But if they're not, if they're just wasting every dollar you give them in taxes and the services are still terrible, even though you're paying 40% a year to them, and the crime, it makes you unsafe. Like, I don't want to go on a date night with my wife. When I was in Vancouver with my wife, I had to give her a curfew. I don't want her out at night Absolutely not. Downtown Vancouver by herself at 7 p.m. No. You're with me or you're in the house. Like, that's not right. When she's in Taiwan, she can go home at 2 in the morning by herself. Nothing's going to happen to her. It's one of the safest countries in the world. And Dubai's the same thing. That's the way it should be. That's how people are supposed to live. If you're in London and you're a millionaire, what are you doing? Literally. You remember that movie, Out of Time? I think that's what it's called. The Justin Timberlake movie where they have like the time on their wrist. And there's that poker scene where he's playing, and the scene where he says to the guy, how does it feel knowing that only a random act of violence could interfere with your, basically your bougie lifestyle? When you make it in life and you've got a successful business and you're making progress, really the only thing that can derail you is making bad macro decisions like living in downtown London, where even if you're wealthy, you could get your arm chopped off because you have a gold watch on your wrist. Like, just don't do that and your life is going to be great. So that's why people move to Singapore. They move to Morocco. They move to Monaco. They move to Switzerland. They move to Dubai because that's an absolute minimum requirement for humanity. You have to feel safe in the country you live in, and you have to feel like the services are worth what you're paying. Otherwise, what are we doing? So if enough people vote with their wallet and leave the Western legacy countries, the brand name countries, 4 or 5 years from now, they will be forced, like Dubai is forced right now, to provide services well above and beyond because they have to. Right now, these old brand name legacy countries, they feel like they've got you. What are you going to do? You're an American. What are you going to do? Yeah, we're not going to rebuild this infrastructure for 30 years. It looks like it's falling apart. So what? Deal with it. Fix your tires when you go over a pothole. It's not my problem. 4 or 5 years from now, if enough of the millionaires say, there's other places in the world I could go, then Western countries might be forced to start to be more, customer oriented. The customer is always right in Dubai, and that is not the case in Canada. Justin Trudeau and our new guy Carney, they don't care what people think. They don't care that you have to wait 9 months. My sister has to have a knee operation, and she has to pay $30,000 out of her own pocket because if she doesn't, she could get it for free. Canada has free healthcare. Yeah, if you wait 14 months, but you don't want to walk around on a bum knee for 14 months because you've got free healthcare. So yeah, come on. Western countries need to do better. And Dubai, Taiwan, I'll big up Taiwan too. It's a fantastic place. That was a super random tangent, but I should go. The lifestyle here is amazing. Michelin star restaurants, stunning beaches, great entertainment, top schools for kids. You and I should work for the tourism department because we're totally aligned in this. Dubai, again, though, there is one downside, right? Like, it was 47 degrees, I think, yesterday. It set a record for heat in May. I don't know what it was. I think it hit 51 like a week ago or something like that. When you go out now, like I'm here in late May and I'll be here in actually July, but the people who are here are different now. Like the Beckhams are gone. Like Conor McGregor's gone. All these people like Ronaldo, he's not here in the summers. All these people, the millionaires, they don't live here year round. So perfect world, 8 months a year you live in Dubai, and 4 months a year you go somewhere else. And that's only possible, of course, if you have your own business and you have your own online income. But if you can do it, I would absolutely recommend doing it. Just listen to us, two people who absolutely love this place. Now, granted, I don't do much. Only when the wife is with me do we do the Michelin restaurants and all that stuff. But I'm sure there's so much more in Dubai that I just haven't done because I have no life. All right, how long did it take you to learn Chinese? How hard was it? Do you speak other languages too? So I met my wife in 2010. I asked her out. She's a yoga instructor, and I was just working out in the gym, and I saw this girl, going in and out of the yoga studios, and I thought, I'd like to ask her out, but I don't want to seem creepy. So I went to her yoga classes for like 6 classes, and I basically stalked her that way. And then I asked her out. First time I asked her out, she said no. She said she doesn't date anybody at the club or members or whatever. And I was persistent and went to a few more yoga classes, and I asked her out again, and she finally said yes. But our first date, I didn't speak any Chinese. So it wasn't awkward because we had actually had a good time. It was about a 4-hour date. We had multiple bottles of wine. It was fun, but I didn't learn any Chinese. So for the first 6 months, I was like hours and hours a day studying. So within 6 months, we were chatting. I'd say another 6 months after that, I was what you could call conversationally fluent. And since 2006, I have not studied Chinese. Or no, since 2011, I have not studied Chinese. So my Chinese is basically like conversationally fluent. We speak Chinese in the house often. Her family doesn't speak English, and we do fine. But my Chinese is worse now than the second year that I was with her. So I would say that if you're really serious about it, best way to do it. I don't know if this is going to cause problems in your existing marriage if you have one, but dating a girl who doesn't speak English is a very good way to learn the language. So if you can work that into your current lifestyle, I don't want to get you in trouble and get you divorced, but if you're single, date a girl that speaks the language you want to learn that doesn't speak English. Because certainly in Taiwan, you see a lot of interracial couples, and it's like 99% of them, the dude speaks English, the girl learns English, right? So when you see them out, and we go out, as couples, and you see like a white dude with a Chinese girl, they're always speaking English. We went the other way because my girlfriend and my wife didn't speak English. So I learned Chinese. So I went the other way. And then I learned, 7-8 years later that her English is pretty decent. She just didn't speak English to me for several years. So I thought, oh, well, I got no choice here. It was good. She scammed me, but it was good. It made me learn Chinese. So that's what I would say. You could do fine in 6 months, and within a year, you could be speaking fairly fluently. First couple of months, though, focus on the tone entirely. That's it. Once you get the tone right, at that point, then you can build your vocabulary. But it's really, it's a tone language. So if you can't get that right, you'll be that white guy who thinks he speaks fluent Chinese and no Chinese person can actually understand what he's saying because he doesn't have the tone right. Don't be that guy. All right, last question. What do you think about starting the Wheel of Fun with put ratio spreads and reducing the strike price on the short? This is a too long a question. And reducing the strike price on the short call for $1 when you make 200 USD on premiums, basically chasing VXX. I know what you're saying. How am I going to answer this? I don't want to be rude. This is like a singular question just for you. But I tend to not have strategies that rely on situational markets changing. I tend to, now that's not across the board, but I tend to open and close spreads as the spread that it was intended for. So broken wing butterfly, yeah, you can do that whole thing. Like if it's working out really well, you can sell just one of the strikes and you can flip it around and turn it into a calendar for a long dated such and such. You can do all these things. But it's situational markets, and I tend to have strategy start to finish that's just that strategy. There are times when something sort of comes up, it's an opportunity, it's too good to be true, you can't miss it. And so then you can kind of flip it and change it a little bit. But overall, I would say that it's just not going to land consistently, so it becomes a strategy. It's a once every couple times a year, you might be able to get the right combination. Like you started with your back spread, and what you really wanted was the market to go up for a month and then come down for 2 weeks. And if that happens, then you can do this with the strikes. Sure, go for it. If the opportunity arises, sure. But I don't start any strategy thinking that way because you need the market to cooperate, and we don't really know what the market's going to do. So you can have a hypothesis, but yeah, I just kind of, if I'm opening a ratio spread, it just kind of stays that way. If it starts as a calendar, it's closed as a calendar. Iron condors, I don't spin them into anything else down the road. That's just my style. But just the simple fact that you are asking this question means that you're a pretty solid option trader, and you don't need me to tell you anything. Like, you know what you're talking about here. So if it works for you, which clearly it does, that's just fine. It's not my style, but yeah, do you. I fly to Europe mid-June, back end of August. There you go. That's the way. That's what you do. So it's not like Taiwan's cold either. Taiwan's a hot summer place. So I'm going from hot to hot, but it's not 47, it's 40, 38. That's, there we go. One more. I've never traded options, so I know nothing about iron condors. Can someone like me follow your strategy? You are in luck, my friend, because in the VTS community, please allow me a little plug here for my community. If you join the VTS community on the free trial, so you will go to my website, volatilitytradingstrategies.com. You will go to the subscribe tab. You will sign up for the free trial, and you will get a 2-week free trial. And when you do that, in your free trial for 2 weeks, you will have full access to everything, including our course library, which in it, I'm not logged in the course library, there is a 30-video Iron Condor strategy course. Each video is about 10 minutes. So yeah, you're talking several hours. You could get through it in a weekend. And then if you want to ghost and you don't want to pay the subscription, you cancel before the 2 weeks and it costs you nothing. But there's a little free tip. You didn't hear it from me, but you can sign up for 2 weeks. And if you like what you see, you can stick around. And if you don't, glad I could help you out. But obviously on a live stream, just take the 30 video course, right? I can't do it in a live stream. So that's what I would say. Sign up for the free trial. 2 weeks later, consider what your next move is. But thank you, everybody. We will be back next week. Regular live streams. I got to get consistent with this. So take it easy.